everybody. My name is Tom Sheridan from 7 Investment Management, and what I'd like to do today is talk a little bit about the 7IM funds and the progress that we've made within 7IM over the last few years. Now, for those of you who don't know us, what we're trying to do is to accomplish 3 rather straightforward objectives. Number 1, we'd like an investment management program that has less than average risk, has less than average cost, and has a little bit better than average performance. Well, wouldn't everybody, you would say? Well, sure they would. However, the way that we do that is we think that the cost and the performance are interrelated, particularly in a world where we're looking forward to potentially lower returns from the investment portfolios themselves. So if you had 2 portfolios, both with equal levels of risk, and one of them cost less, well, which one is going to perform better? The one with the lower cost, of course. The way we go about that is we have a starting position, or what we call a strategic asset allocation, which is an asset array for 4 different levels of risk, which is based upon historical performance of the asset classes. In fact, these strategic asset allocations, as we call them, represent almost ideal portfolios for the given levels of risk for yesterday, but not necessarily for tomorrow. So therefore, we superimpose on that the strategic asset allocation, which is a view taken by the 7IM Asset Allocation Committee as to what it is that we're looking at in the outside world, in markets, and how to apply that to the strategic asset allocations. So we tilt them a little bit more conservatively or a little bit more aggressively, depending upon the view of the Asset Allocation Committee. You can see here in this slide that for the 4 different levels of risk represented by the columns, that each one of them down the bottom has an expected return and a standard deviation. The standard deviation is a measure of risk. The bigger that number, the more risk in the portfolio. What we're trying to do is we're trying to achieve, over the course of time, the expected levels of return with as little risk as is possible. One of the things that the FSA has been arguing about with the community for the last few months is what it is that you call a fund. When is cautious, cautious? When is balanced, balanced? And in fact, 7IM and the Investment Management Association, or the IMA, have a difference of view on what things ought to be called. As it turns out, our view these days is more attuned to what the FSA thinks than what the IMA thinks. So if you go back to that previous slide, you'll see in the balanced column that we have 41% average in equities over the course of time, whereas the Investment Management Association would say balanced managed is anything up to 85% in equities. We don't think 85% is what would come to mind to a client when you say the word balanced. We think something like 41% in equities, 39% in fixed, and the balance in alternatives and cash would be more what a client would think of as balanced. So therefore, the balanced portfolio for 7IM sits in the cautious managed sector of the IMA. And you can see here that the expected returns, represented by the 50th percentile, are about 7.19% over the course of time. When the actuaries arrive at this expected return from that variety of asset classes that we just showed you, they ignore cost. So this is 7.2% that we expect before cost. The second thing that the FSA has been asking us as asset management firms to tell investors is how much money they could lose. So what we've also done is we've calculated what those asset classes would have returned over time, historically speaking, for 1-year periods, 3-year periods, 5-year periods, 10 and 20. And you can see here that over 1 and 3 years, you get a very broad range of probable outcomes with the 7IM asset arrays. From 5 years forward, you can see that the range of probable outcomes narrows. Therefore, we tell people that if your client has short-term money, that 7IM may not be appropriate, and as a matter of fact, probably is not appropriate for those investors. So longer-term, conservative types, steady Eddie performance type clients is the client that 7IM is most appropriate for. And you can see what the probable outcomes would be there numerically for a balanced portfolio, and also here for a moderately adventurous portfolio. So you can see that the return has moved from 7.19 up to 8.16. However, you're taking on additional risk by looking for that additional return. Now, the Asset Allocation Committee that takes that short-term view that we superimpose on the strategic is pictured here. Each member of this committee, on average, has been managing money for about 27 years each. So you need a few wrinkles and gray hairs, or perhaps no hairs, to get into the committee. However, we have a number of current or former chief investment officers in the committee, and each member has a different area of expertise. So we have one with emerging markets expertise, one with fixed interest, one with property, one with currencies, etc. And we have a few generalists in there as well. You can see the level of diversification here in this slide. This is a much more broadly diversified portfolio than is normal for the retail world. And it is this degree of diversification that provides the lower level of volatility or the risk reduction. You notice in the right column, other assets are made up of things like commodities and private equity and property and hedge funds and currencies. These are in the portfolio because they don't behave like fixed interest and like equities. So they have the so-called low correlation to fixed income and equities. And this is one of the things that helps to dampen down portfolio volatility in line with what 7IM wants to deliver, which is the lower risk. Right? And this is what it looks like for a balanced fund on AAP. Now, AAP stands for Asset Allocated Passives. So we took a version of our portfolios with the asset allocation that is created by the strategic and the tactical, and we fulfilled it with completely passive instruments. And the reason for doing that is to drop the cost, and we've been very effective in doing so. So what we'll do now is try to graphically show you what we numerically showed you just a moment ago. So here's your straight line for a balanced portfolio with the 7.19 expected return over time. These are the range of probable outcomes, the lower probable outcome and the upper probable outcomes, to a 90% confidence level, which means that 5% of the time you could be worse or 5% of the time you could be better. 7IM multi-manager portfolios have been in existence for 7 years now, and so we have publicly available track records. And what we've done is we've now superimposed what the annual compound returns look like in the 7IM balanced portfolio for multi-manager over the course of that 7 years. Please note that the black line, which denotes the 7IM performance, is inclusive of fund costs, whereas the expected return ignores costs. So the actual expected return is probably a little lower than what that orange line would denote. And here you can see the actual numbers. So 7IM has produced 6.57% annual returns after cost compounded, as opposed to the 7.2 pre-cost figures that we were expecting. Now, even though we had 2008 in this time period, so we had a so-called black swan event, the numbers have held up. So 7IM appears to be doing pretty much what it says on the tin, which is indeed the object of the exercise. The next higher risk level, moderately adventurous, which sits in the balanced managed sector of the IMA, has a graph that looks like this. And you can see again that the actual results are very close to the expected results over the course of time. The results here, instead of the 8.16, are 7.55, and again, the 7.55 is after fund cost, and the 8.16 ignores cost. If you want to look at 7IM versus the industry, for the balanced portfolio, which again sits in the cautious managed sector, you can see that in the volatility column for 3 years, 5 years, and 7 years, that we've been very close to the industry volatility. But you can see that our performance has been superior. So we've been in top quartile for 3, 5, and 7 years within this category. For the probably more suitable explanation of what 7IM is trying to do, we'll look at the balanced managed sector, or the 7IM moderately adventurous portfolio, and you can see that we have lower volatility than the industry sector, 13.83 versus 15.95 for 3 years, 11.58 versus 13.32 for 5 years, et cetera. And you can see that we have been in the second quartile, so a little bit better than average performance for lower volatility. Now, interestingly, what you see, if you stay in the second quarter for long enough, in the 7-year figure, we come up in the top quartile. And that is exactly the theory that 7IM was founded upon. In terms of cost management, the industry has a 2.27% average total expense ratio, and you can see that the AAP funds for 7IM are well below that. So the passive instruments within the funds are doing their job. And you can see that the institutional share class, which has an industry average of 1.66, that the 7IM funds are less than half of that. So 7IM AAP funds in particular represent extraordinarily good value when it comes to multiple asset class investing. So long story short, what we've been trying to do is to provide a little bit better than average performance for less than average risk and less than average costs. And I think we've done the first one, I think we've done the second one, and I think we've done the third one. Thank you very much for your time and attention.